Enjoy life in the tax lane? The learning doesn't need to stop here. Subscribe to Monthly Tax Update to dig deeper into the critical items accounting and financial professionals supporting owner-managed businesses need to consider and action. As always, Joe, Cait, and Hugh curate content with a focus on practical application, along with links to source documentation to help you advise with confidence. Breathe a little deeper knowing that you have the information you need to best support your clients. Learn more at videotax.com. The following presentation has been prepared by the Video Tax News team for Canadian tax and financial professionals. Program recorded May 28th, 2026. Enjoy.
Welcome to the June edition of Life in the Tax Lane. Hugh, how are you doing today?
It's a great day. We got a lot of great stuff to talk about. And Cait, we get extra minutes because Joe is on vacation. And I was going back through some of our older Life in the Tax Lanes. And it seems like Joe and I have taken a lot of vacations, but you're the stalwart who shows up every month. So what do you want to talk about this month?
I want to talk about my vacation for next month. But in all reality, no, we're going to talk about some tax changes. And this month is no different from several other months. We got lots of adjustments. This month, we have Bill C-31, which is the second budget bill that has been introduced in the House of Commons. And what's fascinating about this Bill C-31 is that it is chock full of not just stuff from budget 2025, but also tons of other measures. Some items that I wanted to highlight here: immediate expensing of manufacturing and processing buildings, that was included here. Lots of practitioners in the M&P sector are looking forward to that. Automatic tax filing by CRA of certain low-income individuals to get them into the tax system, to get them federal benefits that they are entitled to. That's included in this bill. And what I found interesting here is some of the tweaks to the proposals from previously noted to what is in Bill C-31. So, for example, as part of the proposal, an individual is required to tell CRA if the information that CRA has on hand, and CRA needs to provide it to the individual prior to the filing, if some of that information is incorrect or incomplete. And if the individual does not say anything to CRA files on the individual's behalf. Well, the legislation deems the individual to have filed, but it also means that it's that individual's return, and there is a misrepresentation in that return, allowing CRA to open up those returns beyond kind of the normal reassessment period. So just by zipping your mouth and not saying anything, it's not going to protect you from future assessments. Hugh, the other thing in C-31, I get nervous just thinking about it, these tiered corporate structures. What's your bottom line?
Well, I wish it was the other thing, Cait. That bill is well over 300 pages, and it's not all financial, but buried in the middle of it are those tiered corporation proposals from the budget that are going to suspend dividend refunds. So if you operate in the private business, the Canadian-controlled private corporation, CCPC world, this is coming down the pipe and we're going to have to learn it. It will apply to corporate year ends that begin on or after November 4, 2025. So we got a few months left before any full year ends are affected. But what's the target here? The concern from the Department of Finance is deferrals created by staggered year ends. So we've got our corporation that's got refundable dividend tax on hand. It pays out a dividend. It gets that back. So far, so good. Maybe it pays it up to another corporation. That corporation is going to have to pay Part 4 tax. And if it's connected, only repay its share of the dividend payer's dividend refund. So let's keep it easy. We've just got OpCo that's 100% owned by HoldCo. CRA or finance in this instance, their concern is OpCo's got a year end of October 31st. It pays its dividend up to HoldCo. HoldCo's year is August 31st. Well, OpCo pays a dividend in October of 2026, and they don't get their Part 4 tax back until August 2027's year end is filed by HoldCo. And could we have another corporation getting dividends? How far along can we play this? Finance says enough is enough. And who do I have to watch out for here? I need to look for a holdco that is affiliated with OpCo immediately before the payment, affiliated only, so some connected corporations won't be affected. Holdco needs to be a corporation that's subject to Part 4 tax, so normally that's going to be private corporations. And Holdco's year end has to end after PICO's year end so that we can get that deferral. If we meet those three criteria, we have the potential to fall into these really complicated rules, in which case PICO may not get its dividend refund immediately. And if we fall into enough complexities in these rules, may not get it ever. So this is going to be an area that we're going to be looking at a lot in the coming months.
And I think you hit the nail on the head, Hugh. Some of us say, you know, we deal with owner-managed businesses, OpCo, HoldCo. This is not an issue for us, right? No. You have staggered year ends. That's step one. Like you mentioned, you got to be looking at these rules. So I think it's going to be very difficult for practitioners to bury their heads in the sand. This is coming hard. This is coming fast. And it makes me sick to think about it, even though we're trying to dig through these rules. Let's carry on with the next item here. Last month, we spoke about changes at Payments Canada related to in-person payments at financial institutions, noting that effective December 1, 2026, these financial institutions would no longer accept paper-based remittances for bill payments. Thanks to CPA Canada for reaching out to CRA, and CRA provided an update to these changes, noting that CRA is accepted from these rules so we can continue to make our paper-based payments remittances at the banks. CRA, however, did note that the industry direction at the financial institutions is changing and that financial institution support for making these paper-based remittances and these payments is waning, and it probably won't be sustained in the future. So probably changes coming down the pipeline, but just not quite yet for CRA. Other base paper remittances payments, that's done on December 1st, 2026.
Okay, what makes me nervous is how many bank tellers are going to know that CRA is a special exception to the removal of these vouchered payments. I think we could have some very surprised people late next April trying to pay their taxes when the bank won't accept it. So probably a good idea to find another way to remit, even if you can keep this approach going. One other area CRA gave us some recent clarification on. We've had a lot of back and forth on the carbon rebate for small businesses. It was going to be taxable, then it's not going to be taxable, then we're not sure, then we finally legislated it's not taxable. CRA has come out and clarified that if you filed your corporate tax return before June 30th, 2025, and you clearly indicated that you were reporting that rebate amount, they're just going to go ahead and remove it, reassess, send you a refund check. If we can't clearly see it was included, CRA is supposed to reach out and confirm whether or not it was reported for income tax purposes. But if you filed after June 30th, 2025, you're on your own. You're going to have to request an adjustment. We're not quite sure where June 30th falls in because they only talked about before and after, but hopefully that'll get clarified at some point.
Some other clarifications and comments from the CRA. We've spoken about mutual fund trailing commissions. CRA has now taken the position that these constitute taxable supplies. We should be charging GST, HST on them, as CRA has determined that they no longer meet the definition of a financial service. Originally, CRA said they enforce the application of GST on these fees, these taxable supplies, as of July 1, 2026. CRA has very recently said, whoa, we will delay the enforcement of this until January 1, 2028, so financial services dealers can update their systems appropriately. So a little bit more breathing room. However, CRA says, as best as possible, let's start taking and updating our tax treatment according with this new policy sooner rather than later. And if as a dealer you choose to charge GST, HST prior to January 1, 2028, yes, you can still claim input tax credit on the associated inputs related to those taxable supplies. And CRA will be assessing on that basis.
Okay, we got a little bit of a shock to the system from the tax court. This is not going to be good news. If my CCPC is a large corporation, any large corporation that's got taxable capital in excess of 10 million, we're normally watching out for that for small business deduction rules. But I got to be really detailed if I want to file a notice of objection with CRA. I've got to really cover off each issue, what dollars are at stake, why I think CRA was wrong, and anything I don't include can never be raised in tax court. We just saw a case where 3 years appeals went away because they didn't follow that rule.
The Video Tax News team has been providing Canadian accounting professionals with practical tax information for over 40 years. Subscribe to one of our tax newsletters or join us as we present live and pre-recorded seminars relating to both personal and corporate tax. For more information, go to videotax.com. The preceding information is for general informational purposes only and deals with dynamic, time-sensitive, and complex matters that may not apply to particular facts and circumstances. The information provided should not be relied upon as a substitute for specialized professional advice in connection with any particular matter. For more information, go to videotax.com/disclaimer. Copyright Video Tax News, Inc. 2026. All rights reserved.